This is not a trade. This is not a speculation. This is a structural repricing of hard assets against a monetary system that has reached its mathematical limits. The banks are bankrupt. The cycle has turned. The force majeure is loading. And those who understand the difference between paper and metal, between promises and possession, will navigate what comes next. Those who do not, mislearned, will learn the lesson that history teaches without mercy. Ownership is not a certificate. Ownership is custody. The analyst closes the ledger. The screen fades, but the clock continues. Tick, tick, tick. Closing. This has been a hidden currency deep dive into the mathematics of insolvency, the rhythm of cycles, and the endgame of paper promises. If this analysis brought clarity to your understanding of current market conditions, consider subscribing, not because we ask, but because what comes next will require even deeper analysis. Share this with someone who still believes the price on the screen is the price of the metal. They deserve to know. The Benner cycle marked 2026. The insolvency equation confirmed the target. The force majeure will deliver the verdict. Welcome to the age of real money. There's a calculation that no financial news network will perform on live television, a simple multiplication that reveals the true condition of two of the largest banking institutions in the Western Hemisphere. The mathematics are not complex. They are elementary, but their implications are catastrophic. The analyst begins with a single number, $90, the approximate spot price of silver as of this recording. He then takes the rumored shadow short position, 4.4 billion ounces, and he multiplies 90 times 4.4 billion. The result appears on the screen, $396 billion. This is not a quarterly loss. This is not a trading setback. This is what institutional risk managers classify as a solvency event. To understand the gravity of this figure, one must examine the market capitalization of the institutions in question. Market capitalization represents the total value of every share of stock a company has issued. It is what the global market believes the entire corporation is worth. Bank of America carries a market capitalization of approximately $260 billion. Citigroup, approximately $120 billion. Combined, their total equity value stands at $380 billion. The liability from the silver short position, $396 billion, exceeds the combined value of both banks. The mathematics are unambiguous. If these institutions were forced to cover their positions at current prices, their shareholders would be eliminated. Their equity would reach zero. They would be technically bankrupt. But the analyst notes a critical detail that most observers overlook. This calculation assumes they could cover at $90. They cannot. If these banks attempted to purchase 4 billion ounces of silver in the open market, the price would not remain at 90. It would accelerate to 200, 300, perhaps $500 per ounce. The liability is not 396 billion. The liability is theoretically infinite. This insolvency equation explains what occurred on Thursday. The flash crash that sent silver from $92 to $86 in minutes was not profit-taking. It was not technical correction. It was a survival response. When silver touched $92, the risk algorithms at these institutions began generating emergency signals. The liability was crossing the threshold of Tier 1 capital reserves. Margin calls from the clearinghouse became imminent. The banks faced two options. Option 1, admit defeat, buy back the shorts, send the price to stratospheric levels, and file for bankruptcy. Option 2, deploy every available resource to suppress the price. Paper contracts, equity liquidations, algorithmic selling, and push silver back to $86. They chose option 2. The arithmetic of their temporary relief is instructive. By forcing the price down $6 per ounce, they reduced their paper liability by 6 times 4.4 billion, $26.4 billion. In a matter of minutes, they purchased one more day of survival, enough to satisfy the margin clerk, enough to keep the institution operational for one more night. This was not trading strategy. This was emergency triage. They were not seeking profit. They were avoiding immediate liquidation. But the flaw in this survival mechanism became apparent within hours. The price did not remain suppressed. It returned to $90. The $26 billion of relief evaporated as rapidly as it appeared. The banks found themselves precisely where they started, but with one critical difference. They had expended their ammunition. They had demonstrated the limits of their suppression capability. The market had taken note. And while the paper war continued on trading screens, the physical market transmitted a signal that confirmed the terminal diagnosis. Now, that signal is called backwardation. In a normal commodities market, the future price exceeds the spot price. Storage costs, insurance costs, security costs, these create what economists call contango. But the silver market has inverted. The spot price now exceeds the futures price. Lease rates? The cost to borrow physical silver are rising vertically. When lease rates spike, it indicates that physical metal is unavailable for borrowing. The owners of silver are refusing to lend. They are demanding possession. This is the physical market confirming what the mathematics already revealed. The insolvency equation has been solved. The result for the banks is zero. The result for those holding the metal remains undefined. But there is a deeper question the analyst must address. Why is this collapse occurring precisely now? Why January 2026 and not 2024 or 2028? The answer lies not in modern economics, but in a chart drawn by an Ohio farmer 150 years ago. A chart that marked this exact year as the turning point. In the year 1875, a farmer in Ohio lost everything. His name was Samuel Benner. The financial panic of 1873 had destroyed his iron foundry business, wiped out his savings, and left him with nothing but time and questions. Why do markets collapse? Why do panics occur with such devastating regularity? Is there a pattern hidden beneath the chaos? Benner spent years studying price data, corn prices, iron prices, cotton prices, bank failures. He analyzed decades of economic history, searching for the rhythm beneath the randomness. And he found it. What Benner discovered was not a theory, it was an observation. Markets move in cycles, not random cycles, predictable cycles, cycles driven by human psychology, credit expansion, commodity production, and the unavoidable mathematics of boom and bust. He drew his findings on a single sheet of paper, a hand-drawn chart mapping the future of financial markets, decade by decade, for over a century forward. He published it in 1875, and then he waited. The Benner cycle chart divided years into three categories: years of panic, when markets crash and fortunes vanish; years of good times, when prices reach maximum elevation; and years of hard times, when depression grips the economy. But the critical insight was not the categories themselves. It was the sequence, the rotation, the inevitable turning of the wheel. Analysts who have studied the Benner cycle note its accuracy with a mixture of fascination and unease. The chart predicted the panic of 1891. It predicted the crash of 1907. It predicted the catastrophic collapse of 1929, 54 years before it occurred. A farmer in Ohio marked the year that would define the Great Depression. The chart predicted the bottom of 1932, when stocks reached their lowest point in a generation. It predicted the technology bubble peak of 2000, 125 years in advance. It predicted the financial crisis of 2008, when the global banking system came within hours of complete disintegration. Each turning point marked decades before it arrived. The analyst now directs attention to the current position on the cycle, the year 2026. On Benner's original chart, this year carries a specific designation: a year of good times and high prices. The time to sell stocks and values of all kinds. The language requires careful interpretation. Good times does not indicate safety. High prices does not indicate opportunity. These phrases mark the peak, the blow-off top, the moment of maximum danger. This is the point where the uninformed celebrate, while the informed exit, and moves to hard assets. The year the rotation begins. The banks did not read the chart, or perhaps they read it and believed themselves exempt. Bank of America and Citigroup constructed their massive short positions in silver under one fundamental assumption: the paper system would endure indefinitely. Stock markets would continue rising. Commodity prices would remain suppressed. The rules that governed the last 50 years would govern the next 50. They bet against the cycle. This is the error that destroys institutions. The Benner cycle dictates that capital rotates. It flows from paper to hard assets at the peak, and from hard assets to paper at the bottom. This rotation is not optional. It is not a suggestion. It is the gravitational pull of financial history. When confidence in paper reaches its maximum, the collapse begins, and capital seeks shelter in the only assets that cannot be printed: commodities, gold, silver, land, energy. The banks positioned themselves on the wrong side of this rotation. They sold silver short, betting that hard assets would decline, precisely as the cycle dictated hard assets would explode. They are standing on railroad tracks, arguing that the train is not coming, while the ground beneath them vibrates. The analyst draws a parallel to 2008. In that year, the banks believed housing prices could never decline nationwide. They constructed derivative structures worth trillions based on that single assumption. When the assumption proved false, the system nearly collapsed. In 2026, the banks believed silver could never breach $100. They constructed short positions worth hundreds of billions based on that single assumption. The assumption is proving false, and the system is responding accordingly. But there's a critical difference between 2008 and 2026. In 2008, the solution was liquidity. Print money, fill the hole, stabilize the system. In 2026, the hole is not denominated in dollars. It is denominated in ounces, physical silver. And the Federal Reserve cannot print silver. The Benner cycle has turned. The rotation from paper to metal is underway. The banks have bet 4.4 billion ounces. That 150 years of history is wrong. They have bet against the cycle that predicted every major crash for over a century. The analyst does not speculate on whether they will win this bet. He simply observes the mathematics and the history and the pattern. But cycles and calculations do not close positions. Contracts do. And every futures contract contains a clause buried deep in the legal fine print that the banks are now preparing to invoke, a clause that will change the meaning of price discovery permanently. Part 4 will reveal the force majeure endgame and why the price on your screen may soon become meaningless. Reports from the wholesale market suggest this scenario is not theoretical. It is imminent. Industrial buyers are receiving quotations marked unavailable. Delivery windows have extended to 6 weeks, then 8 weeks, then allocation only. When a wholesaler quotes allocation, it means they are rationing supply. It means they do not possess sufficient inventory to fulfill standing orders. It means they are waiting, hoping that metal will arrive before customers demand answers. This is the soft default, the quiet freeze before the public announcement. When the first major institution declares force majeure, the soft default becomes a hard default. The COMEX price becomes a museum artifact, a number on a screen disconnected from physical reality. The analyst projects the immediate aftermath. The paper price may read $90. The street price, the price paid for metal in hand, will gap to $150 overnight, perhaps higher. And this separation is permanent. The paper market and the physical market, which have operated in tandem for decades, will divorce. Price discovery will migrate from New York to Shanghai, from derivatives desks to refinery gates, from algorithms to handshakes. The era of paper-determined pricing will end. The strategic implications extend beyond individual investors. Samsung requires silver for semiconductors. Tesla requires silver for vehicle electronics. Panasonic requires silver for battery connections. Boeing requires silver for aerospace systems. These corporations have relied on the futures market for price stability and supply assurance. When force majeure is declared, that assurance evaporates. Industrial buyers will compete directly against each other, against governments, against refiners, for physical allocation. The analyst describes this as the unobtainium scenario. The metal exists, but the price to obtain it becomes undefined by traditional metrics. The Benner cycle predicted this moment. The insolvency equation quantified this moment. And force majeure will execute this moment. The banks constructed a liability they cannot service. They sold a future they cannot deliver. And now, they will attempt to exit through a legal loophole, while the holders of paper contracts absorb the loss. The analyst concludes with a single observation. Wealth is not destroyed in these events. It is transferred from those who held promises to those who held metal, from institutions that sold paper to individuals who demanded physical, from the banking system that created the shortage to the market participants who recognized it. Then the official number is a fraction of the true exposure. The mathematics of the silver market are fundamentally broken. To comprehend why this position is terminal, one must understand the physical constraints of silver production. The global mining industry, every operation in Mexico, every excavation in Peru, every extraction site in China, Russia, and Australia, produces approximately 800 million ounces of silver per year. This is not an estimate. This is the geological reality. The earth yields what it yields. Humanity cannot accelerate the process. Central banks cannot legislate more supply. 800 million ounces, dotcom is the hard ceiling. Now the mathematics become clear. If global annual production is 800 million ounces, and these institutions have allegedly sold 4.4 billion ounces short, they have sold 5.5 years of total planetary output. They have made promises against silver that will not emerge from the ground until 2031. They have sold metal that exists only as a future possibility, not as a present reality. The analyst identifies this as the textbook definition of a naked short. A naked short occurs when a seller promises delivery of an asset without possessing it, without borrowing it, without any means of acquiring it. It is a promise built on air. In a normal short sale, a trader borrows an asset from a willing lender, sells it at the current price, and hopes to repurchase it later at a lower price. The profit is the difference. But this mechanism requires one essential condition. The asset must exist. It must be locatable. It must be available for borrowing. Where will Bank of America locate 4 billion ounces of silver? The COMEX, the primary futures exchange in New York. Our reports registered inventory of approximately 120 million ounces. That is less than 3% of the alleged short position. The United States Mint, the government's own production facility, has suspended Silver Eagle sales indefinitely. The London bullion market, then the official number, is a fraction of the true exposure. The mathematics of the silver market are fundamentally broken. To comprehend why this position is terminal, one must understand the physical constraints of silver production. The global mining industry, every operation in Mexico, every excavation in Peru, every extraction site in China, Russia, and Australia, produces approximately 800 million ounces of silver per year. This is not an estimate. This is the geological reality. The earth yields what it yields. Humanity cannot accelerate the process. Central banks cannot legislate more supply. 800 million ounces, not always the hard ceiling. Now the mathematics become clear. If global annual production is 800 million ounces, and these institutions have allegedly sold 4.4 billion ounces short, they have sold 5.5 years of total planetary output. They have made promises against silver that will not emerge from the ground until 2031. They have sold metal that exists only as a future possibility, not as a present reality. The analyst identifies this as the textbook definition of a naked short. A naked short occurs when a seller promises delivery of an asset without possessing it, without borrowing it, without any means of acquiring it. It is a promise built on air. In a normal short sale, a trader borrows an asset from a willing lender, sells it at the current price, and hopes to repurchase it later at a lower price. The profit is the difference. But this mechanism requires one essential condition. The asset must exist. It must be locatable. It must be available for borrowing. Where will Bank of America locate 4 billion ounces of silver? The COMEX, the primary futures exchange in New York. Our reports registered inventory of approximately 120 million ounces. That is less than 3% of the alleged short position. The United States Mint, the government's own production facility, has suspended Silver Eagle sales indefinitely. The London bullion market, historically the deepest pool of physical metal in the Western world, reports declining vault inventories and allocation delays. Shanghai, the rising center of physical precious metals, the most trading, is bidding $13 above the Western spot price. Chinese buyers are paying a premium that reflects desperation, not convenience. The metal is not available at COMEX. It is not available at the Mint. It is not available in London. It is not available at any price the banks can afford to pay. This is the condition the analyst describes as a mathematical prison. The banks have constructed their own cell. They have locked themselves inside, and they have thrown away the key. Whether the true short position is 500 million ounces or 4 billion ounces, the conclusion is identical. They are trapped. The violence witnessed in Thursday's trading session now acquires context. The flash crash that drove silver from $92 to $86 in minutes was not organic price discovery. It was not profit-taking by satisfied longs. It was not a technical correction triggered by resistance levels. The analyst identifies it as a survival response, a desperate institutional action designed to reduce mark-to-market liability before margin calls triggered forced liquidation. Every dollar increase in the silver price, multiplied by 4 billion ounces, adds $4 billion to the short sellers' losses. When silver rose from $50 to $90, the banks allegedly accumulated $160 billion in paper losses. The crash to 86 was not strategy. It was emergency surgery. They were cutting to stop the bleeding, but the surgery failed. The price recovered within hours. $90 returned, then 91. The liability rebuilt itself as quickly as it had been reduced. And the banks discovered what every trapped short seller eventually learns. Suppression is not elimination. Delay is not escape. The position remains open. The ounces remain owed. The market remembers everything. The physical market is now transmitting signals that cannot be suppressed by paper contracts. Premiums at retail dealers have expanded to $30 above spot. Industrial buyers report 6-week delays on bulk orders. Refiners have shifted to allocation-based distribution, rationing output among preferred customers. The spot price says $90. The street price says $120. This divergence is not a malfunction. It is a message. The physical market is pricing in a reality that the paper market is still trying to deny. The analyst frames the situation with precision. The banks have sold 5.5 years of future production, but futures eventually become present. Contracts eventually mature. Delivery eventually comes due. When that moment arrives, the banks will not be sellers of silver. They will be buyers, desperate buyers, compulsory buyers, buyers who must acquire metal regardless of price, because the alternative is default. Every short position is a future purchase in disguise. Every ounce sold short is an ounce that must eventually be bought back. The question is not whether they will buy. The question is from whom. and at what price? The answer to that question lies not in trading algorithms, but in a chart drawn 150 years ago by a bankrupt farmer in Ohio who discovered something the banks forgot. Markets move in cycles, and cycles do not forgive those who bet against them. There is a phrase buried in the fine print of every futures contract that most investors have never read. 2 words, French in origin, legal in application, catastrophic in consequence. Force majeure. It translates to superior force. In contract law, it is the emergency exit, the clause that permits a party to break a binding agreement without penalty or without liability if circumstances beyond their control make performance impossible. Traditionally, force majeure applies to acts of God, earthquakes, floods, wars, events no reasonable party could anticipate or prevent. But the analyst observes a disturbing pattern emerging in the language being prepared by legal teams at major financial institutions. They are redefining force majeure. The banks cannot deliver 4.4 billion ounces of silver. The metal does not exist in accessible form. COMEX registered inventory stands at approximately 120 million ounces. London Vaults report declining reserves. The United States Mint has suspended sales. Shanghai premiums have reached $13 above Western spot prices. Every physical source is either depleted, restricted, or priced beyond reach. The banks face a contractual obligation they cannot fulfill, and so they are preparing the legal framework to avoid fulfilling it. The mechanism is straightforward. When a contract holder stands for delivery, expecting 5,000 ounces of physical silver, the exchange has the authority to invoke the cash settlement clause. Instead of metal, the holder receives currency, a check, a wire transfer, digits on a screen. The difference between their contract price and the current spot price, multiplied by the number of ounces owed. The contract is closed, the obligation is extinguished, and the holder never touches the metal. The analyst illustrates the scenario with precision. An investor purchased a futures contract at $30 per ounce. The price rises to $90. The investor believes he has tripled his investment in silver. He stands for delivery. He expects $60. Profit per ounce, paid in physical metal. Instead, he receives $60 profit per ounce. Paid in paper currency. He takes his cash to a physical dealer. The dealer quotes $150 per ounce. The investor realizes the devastating truth. He was settled out of his position at an artificial price, while the real asset moved beyond his reach. The cash settlement did not make him whole. It made him a victim of the final exit strategy.